The stock market in 1900 was a different beast. Fewer companies listed their shares. Trading happened on the floor of the exchange, a frenzy of hand signals and shouts. It was the early days, but the market was growing.
Companies saw the potential. They could raise money by selling shares. This fueled expansion and innovation. The economy grew and the stock market reflected this growth. But risks lurked beneath the surface. Regulations were limited. Investors didn't have enough information. This lack of transparency made the market vulnerable to manipulation. The seeds of future crashes were sown in these early years.
The early 20th century taught investors a crucial lesson. The stock market could be volatile. It offered potential for high rewards, but also came with significant risks. This lesson would be learned again and again in the decades to come. The 1920s roared with economic prosperity. The stock market soared. New technologies like the radio and the telephone changed the game. People rushed to invest, hoping to get rich quickly.
Margin buying became popular. Investors could buy stocks with borrowed money. This amplified gains, but also magnified losses. The market climbed higher, fueled by speculation and easy credit. But this couldn't last forever. In 1929, the bubble burst. The stock market crashed. Panic selling gripped investors. Fortunes were wiped out overnight. The Great Depression followed, casting a long shadow over the global economy.
The Roaring '20s and the subsequent crash taught us a valuable lesson. Unrestrained optimism and speculation can lead to disaster. It highlighted the need for regulation and responsible investing.
The 1930s began with the Great Depression. The stock market crash of 1929 had shattered investor confidence. Businesses struggled, unemployment skyrocketed, and the economy spiraled downward.
The government stepped in to stabilize the financial system. The Securities Act of 1933 and the Securities Exchange Act of 1934 were born. These regulations aimed to restore trust in the stock market. They brought transparency and oversight. Slowly, the market began to recover. The economy stabilized. New Deal programs provided jobs and stimulated growth. The stock market mirrored this recovery, albeit slowly and cautiously.
The 1930s emphasized the importance of government regulation in the market. It showed that government intervention could help stabilize a failing economy and restore investor confidence.
After World War II, the United States experienced an economic boom. Returning soldiers needed jobs, and industries shifted from wartime production to consumer goods. Demand soared for cars, appliances, and homes.
The stock market reflected this growth. Companies like General Motors and Ford thrived. The Dow Jones Industrial Average, a key market index, climbed steadily. This period saw the rise of the middle class and a surge in stock ownership. Investing became more accessible to the average person. Mutual funds gained popularity, offering a way for individuals to invest in a diversified portfolio of stocks. This democratized access to the market.
The post-war boom laid the foundation for a long period of economic expansion and stock market growth. It demonstrated the strong connection between a healthy economy, consumer spending, and the stock market's performance.
Section 5, Turbulent Times, Stagflation, and the Oil Crisis. The 1970s brought new challenges. Inflation soared and economic growth stagnated. This toxic mix, known as stagflation, baffled economists and policymakers. The stock market struggled to find its footing.
The oil crisis of 1973 exacerbated the situation. OPEC, the Organization of Oil-Producing Countries, imposed an oil embargo. Oil prices quadrupled, sending shockwaves through the global economy.
The stock market plunged, experiencing one of its worst decades. Investors grappled with economic uncertainty and geopolitical tensions. The 1970s underscored the market's vulnerability to external shocks like oil price spikes and geopolitical events. It served as a stark reminder that economic prosperity and stock market growth are not guaranteed. It highlighted the impact of global events on the market and the challenges of managing inflation and slow growth. Section 6. Tech takes over. The market rebound of the 1980s. The 1980s saw a resurgence in the stock market. Technological advancements, particularly in personal computers and the internet, fueled this growth. Companies like Apple and Microsoft became household names.
The Federal Reserve, under Chairman Paul Volcker, had tamed inflation. Interest rates fell, making it cheaper for businesses to borrow and invest. This stimulated economic growth and boosted the stock market. Financial deregulation also played a role. The removal of certain regulations fostered competition and innovation in the financial industry. New financial products emerged, attracting more investors to the market.
The 1980s demonstrated the power of technological innovation to drive economic growth and stock market performance. It also highlighted the impact of government policies, such as interest rate management and deregulation, on market trends. Section 7, .com, Dreams and the Bust that followed. The 1990s witnessed the rise of the internet and the dot-com bubble. The internet's potential seemed limitless, and investors poured money into anything with a .com at the end of its name.
Valuations skyrocketed, often detached from companies' actual earnings or profits. The market was driven by speculation and the fear of missing out. But this unsustainable growth couldn't last. In 2000, the dot-com bubble burst. Many internet companies lacking a solid business model collapsed. The Nasdaq, a tech-heavy stock index, plummeted. Investors who had poured their savings into dot-com stocks lost fortunes.
The dot-com bubble and its aftermath served as a harsh reminder that even in a time of technological innovation, fundamentals matter, valuations eventually align with earnings, and speculation-driven growth is unsustainable.
After the dot-com crash, the stock market recovered. Low interest rates and government policies aimed at stimulating the economy fueled this recovery. However, a new bubble was forming, the housing bubble.
Easy credit and lax lending standards made it easy for people to obtain mortgages, even with questionable creditworthiness. Housing prices soared. People saw their homes as investments, further fueling the bubble.
This boom in housing construction created jobs and boosted the economy. However, it also led to a surge in subprime mortgages, loans given to borrowers with poor credit and a high risk of default.
The stage was set for another financial crisis. When housing prices began to fall in 2006, the bubble burst. Defaults on subprime mortgages surged, triggering a chain reaction that would lead to the 2008 financial crisis. The 2008 financial crisis was the worst since the Great Depression. It began with the bursting of the housing bubble, but quickly spread throughout the financial system.
Banks had bundled subprime mortgages with other assets and sold them to investors worldwide. When housing prices fell, the value of these mortgage-backed securities plummeted.
Banks suffered massive losses and the financial system froze. Credit markets dried up, businesses couldn't get loans, and the economy plunged into recession. The government intervened with massive bailouts and stimulus packages to prevent a complete financial collapse.
The stock market, reflecting the panic and uncertainty, experienced its steepest decline since 1929. The 2008 crisis exposed the interconnectedness of the global financial system and the risks of excessive leverage and unregulated financial innovation.
It led to stricter regulations and greater scrutiny of the financial industry. Following the 2008 financial crisis, the stock market embarked on a remarkable bull run. This bull market, the longest in history, was fueled by low interest rates, quantitative easing, and the continued rise of technology.
The Federal Reserve maintained low interest rates to stimulate the economy. Quantitative easing, a policy where the central bank buys bonds to inject money into the financial system, further supported asset prices, including stocks.
Technology companies, particularly those in the social media, e-commerce, and cloud computing sectors, led the market higher. Companies like Apple, Amazon, Facebook, now Meta, and Google parent Alphabet achieved trillion-dollar valuations.
The 2010s bull market demonstrated the resilience of the stock market and its ability to recover from even the most severe crises. It also highlighted the growing influence of technology companies on the global economy and the stock market.
The COVID-19 pandemic in 2020 sent shockwaves through the global economy and the stock market. Lockdowns and business closures caused a sharp recession. The stock market experienced its fastest ever bear market decline.
However, the market recovered quickly, aided by government stimulus measures and the Federal Reserve's actions. The pandemic also accelerated existing trends such as the growth of e-commerce and digital transformation.
The rise of cryptocurrencies like Bitcoin and Ethereum added a new dimension to the market. Cryptocurrencies operating on decentralized blockchain technology gained popularity as alternative investments.
Looking ahead, the stock market faces both opportunities and challenges. Technological advancements, particularly in artificial intelligence and sustainable technologies, are likely to create new investment opportunities.
However, geopolitical uncertainties, inflation, and the potential for tighter monetary policy pose risks. The future of the market will likely be shaped by how these factors interplay.
Investors need to stay informed, adapt to changing conditions, and maintain a long-term perspective.